Hey, Richard Matthews of Matthews Wealth Management. We're going to be talking about 401ks today, specifically the old ones that you may have had at a previous employer that's been left behind, forgotten, not managed, and just part of retirement that we haven't gotten around to yet. So let me talk a little bit about what a 401k is. The terminology 401k is actually a subset of IRS code that talks about the qualification of taxes, about tax deductibility of contributions, future taxability of distributions, blah, 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 right? So the gist of what a 401k is it's a trust that a company runs as a fiduciary for the beneficiaries who happen to be the employees and the retirees from that company. So as you're a beneficiary of a 401k, you do not own your money until you take ownership of that money. So as those 401ks exist out there in the ether, you can track and get your statements and keep up with the value based on the underlying investments. But what I want to do is empower you to be able to understand your specific plan, because all 401ks are not created equal. What I've got here is a summary plan document that I downloaded off of a website for a local Greenville health company. And you can go through here. It's about 48 pages. It's called a summary plan document. And most HR companies can email you a copy of it. And it's meant to be a summary, so it's simpler reading than a prospectus. But it's still got some details in there that's kind of hard to sift out. So there's a website that you can go to that's free to use for the public. It's called Brightscope, BRIGHTSCOPE.com, and you can search for your 401k. And what they've done is they've taken these summary plan documents and made it apples to apples comparison, and you can see how your plan stacks up in terms of investment options, in terms of how beneficial the match is compared to the peers of your industry. And it'll also outline the Form 5500 that you can look at very, very detailed information about the plan. So that's what I've got here, and that's what we're going to cover on the video today. The first thing on this example, I'm not going to name names, but this example I pulled from the 5500 participants. So we have active participants, and then we've got current retirees, right? So they still have their 401k. So in this example here, which is a real example, we have 435 active participants and 134 retirees for a grand total of 569 beneficiaries out there that have accounts in this actual 401k. So the next thing that we want to look at is this trust or account audited, right? So a lot of these companies, they're required to act in the beneficiary's best interest, and therefore they have to have their trust and their accounts and their expenses, balance sheets all audited by an outside independent party. So in this example, the auditor is very common, Dixon Hughes Goodman. LLP. And this most recent one was a limited audit. I'm not going to bore you to death with auditing, but it's good to make sure that they have been audited and what time frame it was a full audit versus limited audit. But all of this stuff is available on Brightscope. Then we have the type. So 401k is kind of a catch-all. You may have heard of profit sharings, 403bs, all of these subsections of IRS code. In this example, we have a 401k as well as a 404c, which is actually kind of a new disclaimer here, and it has to do with limiting a little bit of the fiduciary duty. That kind of came up over the last few years, but this is a 401k 404c type plan. So a lot of these plans are required to have a certain amount of money there to protect the beneficiaries in the case of abuse or fraud or something that gets by and gets caught in an audit or something. So this actual 401k has a fidelity bond of $500,000. And so each year, the plan itself pays an expense to have that bond on hand in case it's needed, and hopefully they never will be needed, but you never know. Enron happened. So then we have total investments, which is interesting. You can look at the amount that's in a trust or a stable value fund. In this case, Wells Fargo manages their stable value fund. But then we look at the actual invested assets as well. And I've combined those together, and I'm just going to call it investments. In this particular plan with 569 participants, we have $17,371,701. So it's kind of interesting to figure that out. You can then run all sorts of calculations, find your average account balance size, and there's also contributions when we get into the income statement. But this is kind of what I want to start with. I kind of want to hang on to what the total amount of investments is, because when we come back, we're going to talk about the next section of understanding your 401k, and most importantly, when we're talking about old 401ks and what to do with them, we really want to understand the expenses. And that $17 million is pretty important when comparing that. So we're going to be right back. All right, part two on old 401ks. We just uncovered the total investments in this 401k plan, and we're now going to talk about the next very important piece of the Form 5500, which is specifically the expenses associated with administering the plan. So these fees and expenses don't come out of client accounts. It's not going to show up on your statement. It's not going to be something that's going to be itemized in there. However, it is important to understand that there are costs associated with administering a 401k plan. So there are a number of companies that are out there, and that's their sole business, is to manage 401ks and administer and make the job of the HR department a lot easier, instead of each HR company trying to run the benefit of a 401k plan. It gets outsourced. So in this example, we have American Pensions, and American Pensions gets paid directly from this plan. American Pensions, and they are earning per year $47,459. Okay, and that's for record keeping, for having all the statements come out, for keeping the accounting up to speed. But American Pensions this is kind of what they do for a living. So that's a pretty good amount of money that's going out for just this one plan that they're managing. There's also South State Advisory. And now we're getting into the actual investment choices available, and sometimes you'll have a financial advisor that comes into your office and sits down and says, "What's your risk?" and then puts you in one of these portfolios. Well, that's where the advisory side of these 401ks come into play, and they're getting per year $15,470. Which isn't a ton of money, honestly, on the overall $17 million. That's not a lot, but it is a cost, right? And it does come out of the plan, and therefore it comes out of the returns that are generated on the underlying funds of each of these shares that people own in their accounts. So if we add those two up, we have a total of $62,928. $29. That's interesting. Another rounding error here. But what that boils down to, if we take that $62,928 or 29 and divide that by the $17,371,701, what we find is an expense percentage, right? So percentages are the best way to compare different types of investments or accounts and overall performance, obviously. So that's an important number to understand. It would kind of be the equivalent of looking at a sub-account cost or administrative cost on a variable annuity or a mutual fund. In this example, that equals 0.3 That's actually kind of high. Typically, you'll see these in the 0.25 range, but 0.36 is high because you basically have two cooks in the kitchen here that are charging. So 0.36 is a little bit on the high side, but we want to look at the last piece of overall cost that happens inside of your old 401k, and that is the underlying fund, right? So we talked about South State Advisory. Their job is to kind of put you in what your pie chart looks like, one of those cookie cutter portfolios, but each of those portfolios has different mutual fund shares. So in this case, there might be a 2040 fund or a Vanguard mid-cap index fund or whatever all those funds are. These typically add another 1% in a sub-account cost or a mutual fund cost to bring our total up to 1.36% per year, right? So the benefit of having the 401k in the first place, and the most important thing to understand for 401ks, is they're really good for the employer and the employee for building up savings on a tax-deferred basis and receiving that match. That's the benefit to the employer, is they're able to give some more for a tax deduction, right? So if we can take advantage of the match, it's free rate of return with no risk. But when we leave it behind in an old 401k, the problem we run into is we're not getting a match anymore. We're actually being charged some fees, a 0.36 plus the underlying sub-account costs. And so each year that we leave it there, we're kind of losing some money. The last thing and most important in my belief is that a 401k, as you're a beneficiary, you do not own your account. Those accounts can be frozen. Certain things can't be bought or sold anymore. If something happens to the company, that's considered assets. So if you're considering looking at the 401k and whether you should roll it over to a traditional IRA, these are some things that should be factored in. In a lot of cases, it makes a ton of sense to move it into something that's going to have more investment options, that you're actually going to be able to own and is protected from company creditors, etc. But obviously talk with your financial professional. There's a lot of different things to put into the equation to determine if it's the right thing for you. So hopefully this is helpful for old 401ks that are sitting out there, what to do, how they work, and where to actually look and reference the resources that you need to make good decisions. So come back next time. We'll look forward to seeing you.